Hey everybody, and welcome back to Investing with Wesley. In my last video, I told you a couple different long-term investment strategies that you potentially use to invest and grow your wealth over time. In today's video, I'm going to show you a couple different short-term strategies that some people use to turn a profit real quickly and grow their portfolio rapidly. So with that being said, let's get into it. Okay, so the first strategy we're going to be talking about is probably the most popular strategy and also kind of the most confusing, and that is day trading. Now, the goal of day trading is to open and close a position in your portfolio within the same trading day. Now, you might be wondering, what does a position and what does opening or closing position mean? And that basically means just buying a stock and then selling or closing that position by the end of the trading day. Now, successful day traders will often work off of momentum and different analytics that will help them determine when it's a good time to buy and when it's a good time to sell. Now, you're not going to be seeing these 20% returns long term like I told you in my last video. Instead, more often than not, day traders actually collect a smaller profit, but because they're collecting a smaller percentage profit every single day, it adds up to large returns month over month, year over year. The problem is though, day traders don't follow any fundamentals like growth or value investors and long-term investors do. The rules when it comes to day traders are often following different signal lines, like lines of support or lines of resistance. And basically what these means is that a line of resistance is a particular numerical value in the stock that it just has trouble going above. Whereas the lines of support in day traders is a particular numerical value in the stock that doesn't seem to get much lower than that number. So if a stock is trading at $100 and falls down to $50, that could potentially be the line of support. If you look at the historical chart and see that every time it dips, it doesn't really dip past $50. That would be a line of support, knowing it probably is a good time to buy. Whereas $100 might be the line of resistance because every time it hits $100 or about that number, it seems to fall. Like I said, there is no fundamentals when it comes to investing like a day trader. It's all patterns and different triggers and signals. Now, just up from that is something called swing trading. And swing trading is kind of a mixture of long-term trading and day trading. There is some fundamentals when it comes to swing trading, but unlike day trading where you're opening and closing positions in the same day, swing traders will often hold on to positions for a couple weeks to a couple months. Swing traders will often find a very good company that has good growth or good fundamentals, a good business strategy, but for some reason has stumbled in share value, meaning the price of their shares have gone down seemingly unexpectedly. Now, this could be something that has nothing to do with business, and that would be your opportunity to buy. As an example, news volatility and bad press could cause a stock to go down, but the fundamentals of the business are still sound. This would be a perfect opportunity for a swing trader to buy in and then wait for the press to clear and the stock to go back up to what it was and sell to collect their profit. Now, whereas in a day trader strategy, the valuations and support and resistance lines are very key signals, in a swing trader strategy, you still want to know the fundamentals, except you're only focused on short-term profits. It's kind of the same thing as a day trader where a lot of smaller profits adds up over time versus you just buying and holding long-term. Now, in both of these strategies, volatility is key. You don't really want a stagnant or smoothly growing company when you're day trading or swing trading. You want something that's trading with a lot of volatility and a lot of ups and downs. That way you can capture the ups and downs. Now, swing trading and day trading are the two most popular forms of short-term trading. The other two we're going to talk about aren't as popular, but can still produce you those large returns like day trading and swing trading can. The third one we're going to talk about is political incentive trading. Now, basically, if you're going to adopt this strategy, you're going to invest in things that your politicians will invest in with insider trading and them passing laws, sometimes in their best interest. But you're also going to pay attention to where those laws are taking us. As an example, here in the United States, there's a big push for renewable energy and going green. So a lot of people will invest in that green energy movement. Now, this strategy could be long-term or it could also be short-term. On the short-term side of things, You kind of want to sell at the end of every year because at the beginning of every year, the positions may change and so might the laws. So trading this strategy on the short term can really help you produce those profits, but also stay liquid in case the strategy needs to change rapidly. Now lastly is the short-term method of rate trading. And this strategy can't really be used as often as the other three strategies, but unlike the other three strategies, when the opportunity arises for you to use this strategy, it's very consistent and pretty low risk. Now, rate trading is exactly what it sounds like. It's making calculated investments when you hear that rates are going to change. As an example, when interest rates rise, the stock market kind of stumbles, and bond prices fall as well. So if you were a rate trader, as I described to you, then you would be shorting the bond market right now because of all the news that the Federal Reserve is going to raise rates at least 3 times by the end of the year. Versus in 2020, when they announced that they were going to be cutting rates almost to complete zero, you would have bought in on the stock market because you knew they were going to rise rapidly. And this works at a fundamental level. We know how interest rates affect the market. We know how interest rates affect bonds and everything else. So taking those calculated trades when the opportunity arises to can help you get those double-digit returns that the long-term strategies can also give you, and has relatively lower risk when compared to something like day or swing trade. Now personally, my own opinion on these 4 strategies is the only 2 strategies that I would recommend, because I do them myself, is rate trading as well as swing trading, and I don't do them often. Like I mentioned in my last video, my investment strategy is often a long-term buy and hold of index investing, and I use a small percentage of that total value to invest in certain swing trades and rate trades, as well as different option contracts. What this does is lower the risk I have to the entire market of my whole portfolio, while giving me the chance to give even greater returns than the market is providing with these smaller trades. In fact, one of my recent videos I made was about the 3 rules I have for option investing, and explained very shortly it's to get at least 100% return on your investment while not exposing you to that much risk. It sounds too good to be true, I know, but watch that video for more details. I hope you got value in this video. If you did, please remember to like and subscribe, as it really helps this channel get out there and grow. I have a dedicated Facebook and Instagram account, so if you ever had a question or comment or wanted something addressed, that's a great place to reach me. Either way though, the choice is yours, and I'll see you in the next episode.